I'm telling you, life changing. That's all I can say, one way or the other. Uh, how to price for wholesale. Hopefully, you're in the correct presentation. Um, we're going to go all through pricing. This is part of a series. Again, I will get into that. Let's get into some housekeeping, maybe. So, this presentation, the purpose was to help you understand pricing. Pricing is one of the hardest things that you're going to do as a business owner. And we want to delve into how being a wholesaler changes that pricing or things you need to consider with the price. This is the third in a five-part series. Slides will be available if you signed up, and this webinar is going to be recorded. If there is a question, please just feel free to put the question in chat. And I just threw a question in there. So if you're new to Zoom, on the bottom, there should be a little blinking button now. That's the chat. And you can just throw a question in there during the presentation. I will try to answer any questions at the end of the presentation. By the end of the presentation, I'm hoping that you'll be able to understand a little better how to determine what your price is. And this is a good presentation for a base, right? You will always be experimenting with your price as business owners as you go and become more sophisticated. But if you're just starting at the base, this is a good place to start. Okay. So, as I said, this is part of a five-part series. We've already done is wholesale right for your small business and how to prepare for your business for wholesale. This one is how to price for wholesale. There are two more presentations that makes up this series that we've partnered with New England Made Show. The New England Made Show is March 15th to 17th this year. So please feel free to register for the webinars. The next one is how to design a booth for wholesale trade. It's on the 5th at 11 a.m. With Stefa is going to be presenting that. She's on today as well. That's always a great one if you're wondering about how the booth needs to be set up or what parameters there are. There's also going to be what to expect at the New England Made Show, and that's going to be a panel of veteran trade show partners or people who have done the show, and they can give you some of their experiences and some hints and tricks. Both presentations, very good. Both will be recorded as well if you can't make those times. But if you can make those times, please register for them. If you register, you get the slides, you get the videos. So don't wait. If you do want to look at the videos afterwards, we put everything on YouTube and we have them in little categories. These videos are going to be under the wholesale category. If you subscribe to our YouTube videos, then you just will get notification whenever we put a new one up. So that's a good way to stay in touch with some of the trends as we do videos on the most trending topics. Now, the summary agenda of what we're going to talk about today, we're going to do just an introduction on why you should, listen to me. I'm part of the SBDC, what my credentials are. We're going to talk about pricing, the 3 points of pricing. We're going to talk about wholesale and some terms that you need to know, like markup, margin, and keystone. We're going to talk about some common pricing strategies very briefly, and we'll get into why it's going to be brief on that in a second. And then we'll have some wrap questions. Now, who am I? My name is Peter Harriman. I'm the Southern Maine Area Center Director. So I cover basically the Southern area with my whole team here. And what we do at the Maine SBDC, we offer one-on-one, no-cost, confidential advising from advisors that are full-time advisors. That's what we do for our job. That is our bread and butter. We can also help and offer some research through SBDC Net or Vertical IQ that helps you with industry standards. And we basically know a wide variety of information for either if you're starting a business or if you're already in business. Either one, you're going to have questions. There's no manual you get when you start a business that says this is what to do. So whether it's understanding how to get a loan, put up a business plan, do financials, market, or even wind down your business, we can try to help you through that and give you resources as well. Now, what we don't do is offer legal advice or accounting advice. There's a line we can't cross. So please be aware of that. There might be a time during our sessions where we say you should talk to a lawyer or you should talk to an accountant. That's because we are not either one of those. But we are 12 advisors full-time throughout the state. Zoom, telephone, email. Certainly, we can do that anywhere in the state, but if you want an in-person meeting, you can see the map there. More than likely, we have an office location within a drive, normal commute for you. So if you want in person, we can also do that, but certainly we have home advisors covering the entire state. Now, how do we do that? Because Maine is a big state. We have partnerships. So if you request advising, you might get an email from someone at USM or Northern Maine Development Commission or AvCog. That's okay. They're all under the SBDC umbrella. In fact, if you see on my video here on the right side, you can see my email address right here. So if you have a question and you don't want to put it in chat, you can certainly email me as well, peter.harriman@maine.edu. Now, if you did want to request advising, you can go to our website and you can just click that request advising button. And that's going to get you into a registration form and we'll get in touch with you fairly shortly. Now, again, we do put all these videos on YouTube. So if you want to look at YouTube, again, there's a playlist broken down by categories. You can look at different categories. You have good marketing videos, financing videos, wholesale videos. Or you can subscribe, and then whenever something goes there, you'll get notified that there's a new video. Now, enough about the introductions. On with the show, okay? That's what you came here for. Let's get this party started. So, where you're at with pricing, what I commonly see when people are thinking about getting into wholesale is normally they've already started their business, right? And right now, their business involves them and the end consumer, right? And there's a pretty simple path there, really just one step, you to them. So when you're thinking about wholesale, you got to think about the fact that you might not be the retailer. You might have a retailer you start dealing with. You become the supplier or the vendor, and both of you might actually work with a wholesale distributor to get your product to the end consumer. So now your relatively straight line looks like this, where you're on one end, you're a supplier or vendor, and your customers are on the other end, right? And as your product is moving through this line, the wholesaler, the retailers, they're all changing the price. And that's what part of this webinar is for, is understanding, one, how do we get to a price that we understand? And then two, how does it change as it's moving through this chain? Pricing is complicated. As I said when we first started the webinar, it is a complicated subject. You need to know a lot of information as far as your target market, techniques, competition, branding. To some extent, you need to know the future. So give yourselves a break. This is a hard subject. It isn't just you. So there's a lot of other people just like that. So during this presentation, I'm going to be giving you little nuggets that if you want to search further into these things, you'll have that resource or that information to be able to look more online at different methods of pricing, right? But the first step in pricing is research. The very first thing is you really got to understand your client and you got to understand your channels, both how you're going to get your product to the client and how you're going to get the resources to make your products, right? That's the very first step, is really that research and understanding what's going on. After that, then we start diving into price determination and pricing strategy. Now, I make this differentiation because when you're looking online, if you're kind of researching this more, online, there's a billion different kinds of pricing strategies, but this webinar is going to focus more on price point determination. Price point determination is understanding at what price you should be selling your product, and that's what we're going to focus on. We will have some brief pricing strategies that is more of a marketing thing, like understanding your market enough to know, do they want buy one, get one? Do I have to round things to the 0.99 for a psychological effect? Do I have brand awareness? We'll get into that. But again, we're going to focus more on price point determination, right? And so when we're looking at how do we determine our price point, it really comes down to three methods that I would suggest doing, right? So as a business owner, you're going to need to know these three methods. One is the cost basis, right? And we're going to go in depth into this method because this is often the first step I have people do when they come to me. And if you're looking it up online, it's often called the cost plus method, right? Then there's the market basis, which when people come to me and I ask them how they came up with their price, this is the one they almost always cite. Competitors, right? Competitor analysis. I looked on the market and this is what it's being sold for by XYZ competitor. Certainly something we're going to look at as well. Again, I usually have people start with the first one, the cost basis, and then look at the market basis. And then there's market acceptance, right? This is their customer perception of value. This is when we get into branding, because if you brand and think about your brand from the beginning, you can grow your price or increase your price above what the cost basis would say and above what the competitor basis would say, because you will be seen as a greater value. So we're always thinking about the brand. Now, here's the tricky thing as a business owner, and this is why pricing is complex. You as a business owner need to consider all three of these buckets at once. So even though I'm going to start with the cost basis, you as a business owner are going to take all these bases and try to come up with your pricing using all of that in the background. So let's start with the cost basis, right? Oftentimes I consider this the minimum price, right? You're trying to figure out your minimum price you want to sell. And that's why I have people start with this. Because if their minimum price is under the competitors, great, you got some room to grow. If your minimum price that you need to sell is above where the competitors are, there could be some problems. So I always have people start first with the cost basis. So what does the cost basis mean, right? It's going to be broken down into 4 steps, right? There's a 5th step when you're doing wholesale, but I want to make sure we understand the 4 steps first to make sure we're at where we need to be. So the step 1, you really need to look at your direct costs, right? This is often called the cost of goods sold or your variable cost. This could include materials, ingredients, packaging, labeling, your components. You can put in shipping costs. That's a whole nother topic there. But these are costs that are directly attributed to your product. So if you make 1, it's 1 times the cost. If you make 10, it's 10 times the cost, right? So we need to understand with your product, what is the direct cost of your products? Now, labor is often thrown into cost of goods sold. But I put a little star next to that, right? This labor is basically how much would you have to pay someone to do this job? Because ultimately, if we're a wholesaler, we're hoping either that we get paid for what we do, or if we're putting in our free labor, eventually we want to, hire someone to take over and do the packaging. We don't want to do it all ourselves. Well, we want to make sure labor is included at some point in the pricing, even if we're not paying it at this point, because we want to make sure we are able to grow and that we're not cutting ourselves off at the knees by not including labor. So labor is very important to include. As I said, many people put in cost of goods sold. We're going to get into that in the next slide on the 2 different ways that you can kind of include labor in your cost pricing, right? But oftentimes with labor, I will say run a test batch with yourself, and that'll help you break down what the labor costs are, right? But let's get into that. Let's dive into that a little deeper. So there's 2 basic methods of calculating labor when you're looking at how do I put it into my costs, right? The first one is like what I just said. You break down the labor per product, right? For each product. And that's usually if you have a product that takes a long time or is very customized or is very expensive, right? The other way to do it, and we're going to dive into it more, is putting the labor into indirect costs or overhead, right? So you think of labor as a fixed cost, and then you can spread it out through your products. Again, we will get into that. So if we were to put labor into our direct costs, this is a business that focuses on one piece at a time. And let's say it's a jewelry maker, right? How many earrings can you make in an hour? Well, in an hour, they can make 3 earrings. Great. If we know our hourly cost is $15 an hour, then we know that for labor costs, each earring should have $5 attributed to it to cover the labor it costs to make that earring, right? Now, this is important for those businesses that can do this, that can put it into a direct cost for a direct product like this, because that $5 per earring becomes a metric on how you're going to measure your future employees, if you're going to hire employees, to make sure that they're doing their job correctly, right? $5 per earring or 3 earrings in an hour becomes the metric. Now, let's say you're a business that can't necessarily break it down per product like that. It's not that easy. So the one I usually go with is a business that focuses on many products at once, and that's a baker, right? They might be, cooking one loaf of bread while making muffins, while having another loaf rise. So they're doing a whole bunch of stuff at once. You can't really attribute that one loaf of bread labor accurately because they're doing a whole bunch of other stuff at the same time. So if you have a business like this, then rather than cost of goods sold, you can try to put it into your indirect or overhead costs by annualizing or you can do it monthly, but by trying to take that labor cost and breaking it down into how much will I end up paying them, right? So in this case, if the baker is working 40 hours a week at $18 an hour, $720 a week, we know that's going to be $37,440 throughout the year. Now, if we divide that by sales, right, we look at the sales, and we're going to talk about that more in a couple of slides, we can understand exactly how much we need in each sale to cover that salary that we just came up with, right? So let's continue the cost basis. Again, step one was a direct cost, what directly goes into the product, whether it be material, labor if you can, packaging, shipping. Step two is what is the indirect cost? And this is the hardest step because whether you're an existing business or you're a new business, you're going to be projecting what the next year looks like, right? You're going to determine your annual overhead cost and your annual sales in units, right? So both of those in red are what you're projecting out. Now, granted, a little further down the slide, it's going to say, if you're a business that's already been in business, then you can rely a little bit on your past historic. But again, we're looking at the future to try to price this correctly, because every year you should be looking at your pricing and making sure that it's correct. This isn't a static. You don't set your price and forget it. You should be looking at this every year. So most of the time, these two things are going to be projections. So when we're looking at the overhead cost and what to be included in there, overhead costs or fixed costs are things like insurance, rent, fees, anything that doesn't matter how many you sell. So if I sell 1 or 1,000, it doesn't matter for my rent. My rent is going to be the same every month. So the overhead cost is that fixed cost. We already have the direct cost understood. Now we're getting the other cost that we have part of the business. And again, that little star, if you couldn't put labor as a variable cost or a cost per good, we can put labor into the overhead as well, right? So again, these are going to be projected numbers going forward because we're always looking at our pricing and trying to understand, are we priced correctly? So we can use the equation overhead divided by annual sales in units. This is if you only have one type of unit, right? And I'll get to that in a second. So a short example would be if you have $30,000 in overhead for the year, and throughout the year, you're going to sell 2,000 units. Great. 30,000 divided by 2,000, we know for step two, just the indirect costs, that $15 per unit should be in our pricing, right? So whatever we had for the direct costs, and now we're adding the indirect costs to make sure that we are selling enough units and getting enough money to cover our overhead costs, right? Now, I always get people that say, Pete, very simple, great. My business is not run like that. I don't just sell one product. I sell many products, right? A little more complicated, not undoable, right? So I'm going to show you how to do it right now. You kind of start with the same starting, right? The same, what is my annual cost? And again, you might have to project what is my annual cost or my overhead going to be. So let's stick with $30,000 just for this example, just so we can understand how to do the math for when you do it for your business. We're going to look at the historic sales if we have historic sales, or we're going to look at projected sales. Let's say the projected sales are 50,000. So you have 30,000 in overhead, 50,000 in sales. So in this example, we're going to have three different products, right? If you have more, you have more. If you have less, you have less. But with the three different products, the $50,000 in sales breaks down into this: 15,000, 1,000, and 1,000. And the amount of sales, the dollar amount of sales, product A with the 15,000, 37,500 out of the 50,000 was from product A, from those units, right? And when we do the math, we were trying to understand, based on that 50,000, what percentage was product A versus B versus C, right? So 75% of that 50,000 was from product A, 15% B, and 10% C, right? And again, projections, you could use historic, but again, we're trying to do the price for this next year. So the important numbers on this that we got was the number of units and the percentages, right? We're gonna grab those and we're gonna bring them to the next screen. So product A, product B, product C, we got the units, we got the percentages, right? Using the percentages, we can now look at what portion of that $30,000 needs to be attributed to that product A. Well, out of the $30,000, 75% of it is 22,500. So when we break it down into the 15,000 units that we think we're going to sell, we know that we should be making sure that $1.50 is attributed to every one of those product A units. And if you sell 15,000 and you have $1.50 for each, you're going to come up with 22,500. The 75% of the 30,000 that you need. And you're going to do that through each product to ensure that, hey, built into the price of all these products is not just the material cost, but it also is covering my overhead cost, right? So now I know I need to add both of these together to make sure I get the money I need. So step one, direct costs, and step two, indirect costs. These are adding up to cover your total cost, right? This is a vitally important number because you cannot sell your product or service below this line without losing money, right? You cannot. If you sell it below, you're either not covering a direct cost or you're not covering overhead cost, right? So you really need to understand this. This is your break-even cost, right? This is your minimum cost you can sell. This is very important, especially if you start negotiating prices, to understand I can't go below this. Now, the next steps, and you'll see this all on one page, but the next steps, there's two additional steps you need. You can't just stop there. The first next step is understanding how much you need in profit to make this worthwhile, right? Now, if you're new to the business, you can tap into the SBDC. We can try to get some industry trends and try to figure out what the average percentage in your industry is. So you can put that in. You might have a number in your head and you can work backwards like you did with the pricing already. But ultimately, you need to build in profit into your business, because if you sold it at just the cost, you're not making any money at all. Because remember, your labor is included. If you're not counting labor now, we included labor in the cost, but eventually we're hoping that that labor is going to be hired by someone, right? If we grow especially. So that labor is already accounted for. So now we need something for us, the business owner. What is going to make us feel happy about running this business and make us able to grow or able to take a vacation at some point, right? Now, the big thing that you understand really quickly when you become a business is there's a lot of taxes, right? So if you're like, hey, I need to make this certain amount of profit with my business, well, we got to understand that there's going to be 25 to 30% taxes on that profit, right? There won't be taxes on the first step, the direct costs and indirect costs. That's your break even. So that's all gonna pan out. Your sales are going to match your costs. That's done. Your taxes are going to be under profit, right? So whatever your needed profit is, build in that 25 to 30% in taxes, because you don't want to get to the end of the year and say, oh, I made $10,000 in profit. Oh, no, I didn't. I made 7,500 because I had to pay 25% tax. So build the taxes right into the pricing now. Okay, so 3 and 4, you're going to combine. It's going to be your profit margin, right? Now, there is a fifth step, and we're going to get to that fifth step that includes wholesale. But right now, we're trying to get an understanding of your base price, right? So let's look at that on one page at this point, right? We got the direct cost and the indirect cost, and we have that line. Remember, that line is your minimum price. You cannot sell below that line, or in this case, above the line. You can't sell below that price without losing money. And then above the line is what do you need to make this worthwhile? And what are the taxes going to be that you're going to have on that to make sure you're making what you want and that you're not making 25% less than what, right? And then we're going to get up in, now we're going to get into the retail markup margin keystone, right? Those are the first terms that you're going to want to know for wholesale. Markup, margin, and keystone, right? And we're gonna go through this. This is going to be probably even more dense than what we just went through. So saddle up, let's go. Okay, markup, not margin. So markup's the amount to increase the price of the product to determine your selling point. It's the amount above the cost that you're selling your product for. Now, I can read definitions all day long, and it's just going to get all jumbled in my head, right? So I have to see it done out in math, right? So for the calculation, markup is the sales price minus the unit cost divided by the unit cost times 100. Again, you're going to get these slides. This is going to be on YouTube. You can pause it and do the math, right? Here's an example of math on what would be a 50% markup. So that's if we had a sales price of $15, the unit cost was $10. We can do the math. It's 50%. Here's the big thing. It's being divided by the unit cost. Doesn't make sense right now, but it's going to be the key determining factor of markup versus margin, right? So in markup, you're dividing it by that unit cost. And here it is for those who are more mathematical, want to see the formula kind of done out. The markup percentage is sales over unit cost divided by unit cost times 100. So in our example, 15 minus 10 over 10, 5 over 10, 0.5 over times 100 is 50%, right? So that's how you get up to the markup. Now, here's the most likely scenario of when you're going to be asked about markup, right? A buyer says that they mark up 125%, right? You're at the show and you ask them, how much do you mark up? I mark up 125%. Okay, so first take your cost. And the cost is the wholesale price that you're selling at, right? And multiply that by the percentage, 125, so 1.25, 10 times 1.25. So the $12.50, that is the amount they're going to mark it up over the $10, right? So we're going to get a final price of $22.50. That's the price with the 125% markup. So as I said, the cost in this case is what you're planning to sell. Because you want to know how much is this going to hit the shelf for if they have 125% markup. Well, if I sell it to them for 10 and they mark it up 125%, then they're going to put it on their shelf at $22.50. Does that work? But again, understanding what your market is as far as your client, and will the client buy it at that? Is that the right match for you? Would that be too expensive? It's going to sell or not sell? That's things that you're going to have to work through. But you want to make sure that you can do the math to understand what that means to your price. Now, you can calculate the retail price if you know the markup percentage. Again, you're going to get slides, so I don't necessarily need to go right through this. But if you know, in this case, $48 is the retail price, you can figure out the wholesale price and the retail price, right? So you can do all of this math one way or the other. So if you understand and you're out competitor shopping, you see the retail price and you know what the markup is, you can reverse engineer that to get up to what that is. So there's a whole bunch of stuff you can do with math. So my biggest hint here, as you're going through these slides and you're looking at it, do the math. Actually go down and do the math, because you need to get good at doing the math on the fly. Right? Once you're dealing with this day in and day out, you're probably going to be able to do this without thinking. but you need to get to that stage, right? Now, granted, we do have computers in this day and age. We have cell phones. We have things that are going to be able to calculate for us. So we can cheat a little bit, but we would ultimately like to understand ourselves what this means, right? So at this point, just to give you a little break, because we're at the halfway point, right? Which product do you believe has the higher markup? High school ring, bottled water, movie theater popcorn, or coffee on the go? Okay, I'm going to give you a second. Throw it in the chat. Which one do you think has the highest markup? Anyone who cheated and watched the webinar from last year, I changed them up. So they're different now. So high school ring, bottled water, movie theater popcorn, or coffee on the go. Anyone want to guess what they think the highest markup is on this sheet? Give me one more second just to break up. And the answer is still bottled water. 4,000% markup. It's 5 cents to make. They sell it for about $2, right? Generally. The high school ring is the next. Then movie theater popcorn, which is still a crazy markup, right? And then coffee on the go, right? So the coffee at Starbucks or whatever. So just a fun little breakup to get us thinking about how crazy markup can get. Now, let's talk about margin, which is not markup, right? They're two different things. Again, definition, I like to use the calculation. So with this one, if we do the math, it comes out 20 minus 10 divided by 20. This is a 50%, right? So in the original one where I did markup, it was $15. Now to get 50% margin, I have to go to $20. And we're going to go a little bit more into this, but the key to this slide into understanding markup versus margin is margin is divided by the sales price, not the cost, right? So markup was cost, margin is sales price. Okay. So when you're doing the math, you're dividing it by a different base, and that comes up with a different number. So what is the likely scenario in which you're going to encounter margin? Buyer says that they must maintain a 75% margin, right? So the desired profit margin of 75%, you're going to subtract it from 1. Again, you're going to have these slides, so don't worry about me going through it fast. That's going to get you to 0.25. You're going to take your cost, how much you're selling it for, $10, divided by 0.25, that's going to get you to $40. So you know they will sell it for $40. To check the math, because it seems like crazy that it would go up that high, we plug it all in, comes up correct, right? So if you're selling to this vendor for $10 and they say they must maintain a 75% margin, that means they're going to sell it for $40. Crazy, right? So if you understand the math and you can do it while you're talking to them, you can have a productive conversation and have a good understanding. Is this going to sell? Like this is what's going on with my price. Is it going to sell at this end price, or do I need to negotiate a little bit, right? So if you want to calculate the retail price, if you know the gross margin, right? Here's an example of $30 and a 60% gross margin. And again, this comes up with the $30 would end up being $75 retail price, right? So you can do the math. And again, the only way you're going to get good at it is if you do it. And I suggest you do it both ways. One, when you know what the wholesale price is and trying to figure out what the margin means and what it comes up with the retail price, and the reverse. Try looking at the retail price, knowing what the margin is, and get it back to the wholesale price, right? Try doing it both ways to make sure that you understand what they are. Now, for a nice visual example of margin, I like using this Nike shoe, the anatomy of a Nike shoe, right? So when Nike sells the shoe, Nike only makes $5 profit on a $100 shoe, right? There's all those other costs, marketing, freight, insurance, custom duty, other expenses, income taxes, profit, So there's all that cost, but when they sell it, they're making $5. And then when that retailer sells it, that retailer has a margin that's $50, right? So that retailer is going to make some money. Not $50 because the retailer themselves have their own costs. But when we do all of the math, which I'm putting up on the right side here, we can see that for the parent here, Nike, you're getting a 10% margin. You're getting a $5 profit. So that's a 10% margin on their shoes when you do the math. For the retailer, if there were no costs, it'd be a 50% margin, right? A $50 profit on the shoe. Again, that's assuming there's no cost to the retailer, but there is going to be some cost. But that's how we can kind of look at the margin and understand the margin when we're looking at this. Now, the bonus for this particular example is that the retailer in this case used something called Keystone, which we're going to get into, which is basically a 100% markup on a $50 cost, right? So markup is not gross margin, right? So markup, we're looking at dividing it by cost. Gross margin, we're looking at dividing it by the sales price, right? So there's a big difference. Markup is almost always higher than gross margin. And we're gonna beat this thing so it really gets into your head. So we're gonna look at it visually. If there's a $100 item with markup and margin, right? So if there's a $100 item and we're going to do a 25% markup, that's the $25. There's a 25% markup. If we're looking at margin, that same markup that was $25 is now 20% as far as margin. So if I were to look at this $125 cost, I can see that if I said 25% markup, it means $125. If I said, oh, there's a 20% margin, that's $125. So we're saying the same thing with two different terms. So you want to make sure you don't confuse them. I see it all the time. People either confuse them and or they use one interchangeably with the other. They are different. So you do want to make sure you know how to calculate them. If you see in the margin, the $100 cost is 80% and we put it up 20%, right? So side by side, if common markups versus margins, a 50% markup is going to be a 13% margin. 100% markup is going to be a 50% margin, right? So as I said, people get confused all the time. I know I'm kind of beating a dead horse, but it's very important that if you're getting into wholesale and you're talking to vendors and you're negotiating and they're using these terms, that you understand what they mean when they say, hey, I need a markup of this, or we need to maintain a margin of this, right? So how I remember them, right? Again, the difference between the two calculations is what we're dividing by. So how I try to remember it is costs march up, sales march in. Okay, so the costs march up, costs mark up, and sales march in, sales margin, right? So costs mark up, sales march in. So think about that as far as same equation, different things that you're dividing by. Okay, so that's how I remember. That's my little cheat sheet for you guys. Now, Keystone, because I mentioned Keystone a couple slides ago, I want to make sure we define what Keystone is. Keystone is basically you double your wholesale price to find the cost. And I see this especially at the New England Made Show when I'm talking to people. Keystone comes up quite a bit when you're talking to retailers. They say, oh yeah, I just do Keystone on my product. So basically, you sell it to me for 10, I'm going to put it in my store for 20. Right? So yeah, 20 manufacturing cost, $40 wholesale price, that two times markup. If you sell it for $40 to the retailer, they're going to put it on the shelf for $80, right? So that's how you determine just Keystone. It's a 2 times markup. Now, Keystone, as I said, is the default go-to. It's the rule of thumb when you're pricing, but it's not necessarily the only pricing, right? I've heard of triple key. I've heard of key and a half. I know that different industries have different kind of pricings. Retailers are a little less for theirs because their profit margins are a little lower. And that's part of what we at the SBDC can try to help you is trying to find research that helps you understand what these rules of thumbs are for your particular industry, right? But if for some reason you can't talk to us, that is what I hear most of the time is Keystone as just the default rule of thumb. So if you hear that term, that's what it means. So now let's look at everything we've learned so far about the costing. As I said, we're going to spend most of our time on costing. Then we're going to get to the other two. So first, understanding the materials, ingredients, and packaging. In this case, I decided to stick with the jewelry maker with the earrings. And the materials, ingredients, and packaging per earring was $7.35. Then I did throw in labor because I was able to break it down. Some businesses can't, but in this case, I was. I could make 3 earrings in 60 minutes, which means $5 per earring. Then I looked at my overhead. And if I thought my overhead was going to be $800 a month, so $9,600 annually, and I thought for the year I was going to sell 480 units. Again, that's assuming just one product. You could do multiple products. Then I can figure out $20 per earring should be what I charge just to get my break even, right? So $32.35, if you add it all up, that's my break even, right? Then I have a needed profit, right? I'm going to do the markup. I'm going to say my needed profit is 20%. So I'm going to add 20% to that. And then I'm going to look at 25% on the 20% markup, which is $6.47. So I'm going to add $1.62. So I know I should wholesale this at $40.44 per earring. Now, you might change the price around to be more whole or to have 99 cents or whatever, but I know at $40.44, it includes my materials, my packaging, my labor, my overhead, and the needed profit of 20% plus the taxes I'm going to pay on that profit. So I know that's kind of the price point I want. Now, if I sell it to a retailer and they do Keystone, then they're going to sell it for $80.88, or more likely they'll mark it up to $80.99 per year, right? And this is just an example of how to break it down. Your numbers, of course, will be different, but this is a nice way to kind of get through and find your minimum amount that you need to sell it for, figure out what profit you need to do to make you happy, and to figure out what the price change might be if you sell it to a retailer through a wholesale, right? So a lot of things going on there. We're going to record it. You can watch it again. I know I put a lot of information on the slides. So the problems with the cost basis for pricing is as you scale up, prices are going to change, right? So you might have pricing for if you buy 100 packages versus 1,000 packages. So there's one problem there. The other one is, like we talked about, you're guessing at your sales and you're guessing at your costs going forward. This is especially pertinent for the third problem is if you're growing very quickly and you're not able to project correctly, your pricing might lag. Right, you might be either overpriced or underpriced, depending on how the math works. So there's the 3 basic problems with cost basis pricing that you want to think about as you're going through it. Right, the fact that it's a guess, the fact that you could get economies of scale, and that you want to keep in mind if you're growing. Right, especially if you're in your house doing free labor right now, the price is going to be a lot different than if you were renting and hiring people. When you do that math. So now, after you establish your cost basis, we go on to determine the market basis, the competitor pricing, and the market acceptance, what your core client perceives as the value of the product, right? Your competitor pricing is basically you're trying to understand what your competitor is going to be pricing at. It does not mean you have to match it. Right, that's a very important thing. I've had people say, "Oh, I had to match or had to compete with Walmart, and so I price the same as Walmart." Walmart's a huge manufacturer. You got to figure out one when you have a client and they're looking at alternatives to your particular product. What alternatives are they looking at, and how will your product stand out from the other alternatives? Right. So do a lot of secret shopping, or you can be even open about it. You don't have to be secret about it. You can just ask people what their prices are and whatnot, right? You can try to understand what the margin and markup is in your typical channel, because then you can kind of work that math backwards, and we'll have a couple slides on that. But keep in mind that you don't necessarily know what's in those margins, right? So you don't get the full story when you're seeing the end product, especially. You don't know what profit margin they decided to go with. You don't know if there's another person in the distribution channel. You don't know if there's bad debt or no debt that they're financing. So with competitor pricing, it's a moving target. You don't know the full story, but it is a good way to understand what your clients are going to see on the marketplace. So you can help price your product. If we did the cost basis and your product's way under what the competitors are, and you have a similar product or similar design or whatnot, great, you have some room to grow. But if you did the cost basis and your cost basis was way high and your competitors are all much lower, that's when you got to decide, okay, is my product significantly different that I can sell it at a higher price? It's got better value or better quality, or is there a problem here with my pricing? Right? As I said, it's always fun with competitors to try to reverse engineer the retail pricing, right? And this is, again, a little more research to understand what's the typical margin people might want, what's the typical markup they might have. And so you can try to go through the math. I won't go through the math now. I'll just have the slides to do it, so you can go back through that. But you can get to your target cost price when you figure out, okay, this is doing the reverse engineer. Now we go to the market perception, right? So once you understand what is similar products selling for out there in the industry, what is my client going to see for similar products? Then we get to the third tier or pillar of marketing, which is what is the perception of my clients? Because even though my clients are seeing these different products, if I can start focusing on my brand and my brand strategy and really making sure that my brand sticks out for whatever my brand wants to be. Usually it's quality, but it doesn't have to be, right? Maybe it's just mass quantities or cheap or whatever. But I'm gonna look at my brand. And the brand is usually tied to emotions, availability, stuff like that. So Apple iPhones are what I like to say, right? You can get a cell phone for $200, $300, right? But if you want an Apple phone, you're going to pay the $1,200, $1,500 because you want that brand value, right? You could get a similar phone cheaper, but you want Apple, so you go with that, or you want that Apple operating system. $490.50 is the cost of an Apple iPhone. That's what it costs to make and ship and get it to your hand. $1,099 is the average retail price. So that markup is you buying into the brand. Right. So how do we understand what our customers are thinking? You can do customer surveys, you can do focus surveys from time to time to see if your brand's taking off in the market. And some surveys, and I have these here so that you can look them up as well, but there's a pricing model survey that I have here, and then in the bottom there's a Gabbard Ranger direct pricing technique, home join analysis, monadic pricing testing. So there's a whole bunch of stuff. And again, the SBDC can kind of help you understand what it means to do a survey and some of the drawbacks of that. But you're trying to understand, hey, what do my clients feel? And again, the focus is, I want to start building my brand. If you haven't started yet, it's really important to really look back and say, I really want to drive that third column. I don't want to be stuck to the cost basis. I don't want to be stuck to the competitor basis. I want to eventually break both of those ceilings and drive my brand value up so I can drive that price up. Okay, the Pareto principle is a very important thing that I like to mention as well, because when we get into business, we want to sell everything, right, to everyone. But the 80-20 rule, 80% of your outcome is going to come from 20% of your causes. So with this, I have a few different slides here, but the ultimate message that I like to give with the Pareto principle is not everyone is going to be your client, right? Now, yes, some of the cons are that you might seem like you're not paying attention to some clients, right? Especially if you're focusing your marketing on a subset of clients that is going to bring in most of your revenue, the 20% there. But you got to get comfortable with the fact not everyone's going to buy it, and that's okay. Part of pricing is understanding there are some people that are just going to look for a different thing. Maybe, a Walmart shopper is not the same as a Target shopper, and that's okay. Both of them are fine, right? Walmart doesn't want the Target shoppers, and Target doesn't want the Walmart shoppers. They've understood their pricing model and their branding, to understand. So you have to start understanding that too of who is my client? Who am I going to get 20% of my revenues from, or 80% of my revenues from? Okay. Now, as I said, we're kind of running short on time, so I'm trying to get through these slides. Some common pricing strategies, and this is why I didn't touch on these. So these are more marketing than getting to your price point, right? There's market penetration. Think Walmart set a low price, sell a lot of them, and you're able to, with a low price, if you sell a lot of them, you still make up the same amount of money. You just have to sell a lot of them, right? Market price skimming, think of Apple with that. So high price for the new product, and then it lowers over time because the new one comes out and that's a higher price, and then it's kind of like that, right? That's called market or price skimming. Location pricing, so like stadiums, you ever go to a stadium and you buy a hot dog and a beer and it's really expensive? Well, that's because the location is more important than anything, right? The convenience of buying it there. Bundle pricing, so internet and cable companies love this, right? Oh, you want HBO, you want this, you want that. Before you know it, your bill is really high because you've added on all these different bundles. So I've seen this, especially with cars, right? They have a base model and then they start adding features in, and that might even be another one. Psychological pricing, when you have the BOGO deals or the 99 cents at the end versus $1, they're emotional. They're trying to tap into your emotion of, oh, I shouldn't miss out on this because this seems like a good deal. That's what they're doing there. Perceived value. So, oh, it's a Coach bag or a Rolex watch. You're looking at that value. Price lining, that's what I was thinking of for the vehicles. Where you have a base model and then all of a sudden you add all the extras and it gets you to different pricing. Or competitor price. Gas stations are famous for this. I've seen people drive 40 miles just to save 10 cents a gallon in gas, right? So gas stations are pretty famous. But there's a lot of different strategies. It's a whole different webinar on marketing and understanding how your product should be marketed for the price. But first, we need to get to what price should we be looking at when we look at the cost, the competition, and the brand value, right? So some red flags, if your price is too low, high percentage orders. So you get orders and they're flying off the shelf, right? You can't keep up. Your lead time stretches out. Your profit margin's going down, right? You feel like you're working more and making less. Is kind of what goes through your mind, right? Or I see this all the time. You haven't implemented a price increase in a long time. I've talked to businesses that I helped start, and 3 years later, they have the same price. Don't do that. You want to continuously update your price. Think of Dunkin' Donuts and Starbucks. I can't think of a single point when they updated their price, but I know 15 years ago, my Dunkin' Donuts medium coffee was like $1.25. Now it's like $3. So at some point they increased the price, but they did it gradually. And so I didn't notice. That's what you want to think about with your business is I want a gradual increase that's going to keep up with inflation, keep up with my costs. I don't want to shock the market with a big price increase. Right? Now, if your price is too high, then you'd either have to do nothing except a lower margin, differentiate your product and explain why the price is high to a consumer, discontinue the product, that's an option as well, or you try to look at your channels and try to figure out how you can reduce costs, right? So there's a few different options for either if the red flags if the price too low or alternatives if the price is too high. Now, when you do look to reduce costs, you can look at direct and indirect costs, you can look at bulk ordering, you can reduce your labor time, you can hire someone. You can join forces with people like a co-op, an association, or partnership. If they're putting an order in and you're putting an order in for the same product, maybe you can join orders. Not as common as I'd like to see, but certainly an option that you could try. Now, I always end with the two basic rules of principle that I got from John Entwistle, right? The market and not your cost determines the price at which your product is set. So even though you have that minimum price, people, if they value it in the market for less, that's what they're going to buy it for, less. So you really want to pay attention to what your minimum price is, and you want to pay attention to the market and make sure you understand where the market's at. And your cost and desired profit only establish a floor price below which you cannot sell and make a profit, right? So those are the kind of the two rules that I live by for John Entwistle, and I hope you'll live by them too. So in summary, know your product, know your market, know your price. Thank you. I know I only left us 5 minutes for questions, so I apologize for that. People watching on YouTube, guess what? You just got like a whole hour's worth there. So now let's go to questions and see if we can answer any of those. And for those of you who don't want to do the calculations, I have a final cheat sheet for you. Okay. So if you're doing markup, margin, or both, here's some calculators that you can use online to try to help you out. But I strongly suggest you do it yourself on paper, because when you're out in the field or out at the trade show, you might not have access to these calculators, or you might not have time to go through that to understand what kind of deal you have. All right. What questions we got? Oh, it looks like we don't have any questions. Did I really go through this with no questions at all? That is amazing, people. I mean, I think I got an award for the day for fast talker and no questions. Yes, knowing the lingo will definitely help. Thanks, Tracy. As I said, this is a presentation that's dense on purpose. You're going to want to watch it a couple times to really let that math sink in, to really get those terms kind of right in your head as you're thinking about it. The different methods of pricing, as I said, you don't just stick to one. I see businesses all the time, they stick to one of those, cost or the competitor. Brand usually comes later, as the lead times go out, they increase. But you want to think of all three of them. If you haven't started working on your brand value, start working on your brand value. Would you say that most buyers are asking about markup or margin? Most clients I know seem to be getting questions about margin and not markup as much. This is one of those things that almost seems like it comes in waves, right? So sometimes I hear a whole bunch of margins, and then sometimes I hear a whole bunch of markups. That's why we want to know how to do both of them, right? But as far as which one I would say leads, I think it's a 50-50 in my mind. But I'd love to hear anyone else who's out in the field and actually being asked this by, maybe Steph, if you've been in the field a little bit, but you're kind of outside of it. But anyone, do you hear mostly that they're asking about markups or margins?
I think it's so individual, Peter. It really depends on the retailer, kind of
Yeah,
what their model is. So I don't think there's one broad brush, or at least there hasn't been in my experience at the show.
yeah. But understanding how to get to both of those, because if you do hear it, as I said, a lot of people, if before the show, they might not understand markup versus margin, and they get them confused. And then when they're talking to a vendor, they say, oh yeah, like I said in the examples, oh, we do 125% markup. Okay, what does that mean my price will be on your shelf? That's what we're trying to ultimately figure out. If I sell it to you, what is the end consumer going to see for a price? And that's what you're trying to do. Yes, a lot of them do Keystone, so it's real simple, just double your price, but not all of them do Keystone. So you want to make sure you can do that math yourself. But before we even do that math, we ultimately need to know, what are our costs? What's the profit margin? What's the taxes? Right? We need to know that base price first to make sure that we really understand how much we can sell for without losing money or without being really busy. I've seen this, really busy, really, everyone seems like you're on fire, and then you close because you didn't make enough profit, right? And you end up just working, and that's all you did. You're like, I work to pay the bills. I don't want that for you people. I want you to work to make money, right?